Hey, everybody. Welcome. Today is a great day. It's Friday. Have you had a good week? Welcome to the Energy News Beat Stand Up. My name's Stu Turley, President and CEO of the Sandstone Group. And today is February 24th. It's Friday. I know that we're all looking forward to getting out of the office. So we're going to run through these really important stories real quick. But first, check out our Energy News Beat Substack. It's the Energy News Beat at substack.com. Ask any questions that you want for Michael and myself, and that is at questions@energynewsbeat.com. We've got several really good stories for you here this morning. The first one, analysis. Healthy gas storage warms Europe, but not enough. China says it's ready to go join forces with Putin. There's some interesting twists going on in there. What is going on with all the crazy optimism? Crazy optimism about China's economy. What markets will get hit the hardest? Energy or consumers? It's going to be kind of interesting to see how that plays out. Plans for new mid-scale LNG project in Louisiana, they gain ground. It's pretty cool. Now, Chesapeake Energy to reduce drilling amid nat gas price slump. So let's take a look here at the first one. Healthy gas storage warms Europe, but it's not enough. Coming out of Oslo, as Europe emerges from a mild winter with gas storage close to record levels, it must brace for another costly race to replenish its reserves on the international market. Now, here's where this is some pretty good analysis going in here. It says the situation on the gas market is currently no longer tense, said Marcus Kreber, CEO of RWE, Germany's biggest utility, told Reuters. We do not expect filling storage to be as costly as next summer as it was the last year, Jacob Mandel, senior analyst at Aurora Energy, said. He also said firms that rely on spot supply to fill storage rather than hedge against future price jumps will risk paying similar costs to last summer. So there is all of the contracts, and I love the way that the author phrased this: contracts in tatters. Russia's long-term contract prices based on complex calculations are not public, but are much cheaper than the spot market rate. This is going to be very interesting to try to find out. LNG for now, renewables for the future is the motto. But people are forgetting that they're not going to be able to get a lot of the supplies for either the renewable or any of those things. So it's going to be really tough. I can't tell you any kind of pricing hedging because we're trying to figure out that we have the really low price, but we've got a bottleneck on getting LNG out. So there's going to be some mixing going on there. We'll keep you posted on that. Let's go to the next one. China says it's ready to join forces with Russia to defend national interests as Putin confirms Xi's visit. I'll tell you, this is kind of crazy. Here we have President Biden going over to Ukraine, and then you had President Xi and Putin cooking pancakes together. Now we have, during a virtual meeting at the end of last year, they were talking about doing this, and he said they will work together like like-minded partners further to promote the development of the international order in the direction of equitable development. They are pulling so close. The biggest fear out of this is that they're going to start arming Russia. And when you take Russia with the most natural gas and energy, and then you have China who can produce most of the weapons, and they come together, and then you have Russia working with Iran, and then you have Iraq and China starting to deal in one. This is no longer a very good situation, and our current administration is not helping anything out at all with this. So take a look. Let's see what's going on. Crazy optimism about China's economy. What markets will get hit the hardest, energy or consumers? This is really kind of amazing because you have the folks that are out there from Goldman Sachs and others that are saying it's going to be 110, 130 because of China's economy and it's coming back. There's a lot in this article, and I'm not sure how I'm going to factor in this number, but let me throw some of this at you, and I want to hear your feedback as well. Chinese consumers trapped inside their apartments during the first parts of the pandemic accumulated more than 2.2 trillion in bank deposits. Financial Times put the figure at 2.6 trillion. But I love the way the author says there's 4 primary reasons to doubt it. First, China's disease statistics are questionable. Really? China portrays smooth COVID exit, leaves scientists wanting more data. So, okay. Second, if China were over COVID as the regime maintains, the economy is still plagued by over dependence on property, which accounts for almost 30% of GDP. So housing is critical because it also accounts for about 70% of the wealth of the middle class. So what we're seeing is throughout the rest of the world is the middle class is dissipating and migrating. The rich are getting richer and the poor are getting poorer, and the middle class is dissipating. This article is also saying the same thing's happening in China. The property sector downturn is hardwired into the first half of 2023. The Rhodium Group last month reported that. Third, the Chinese economy is far weaker than Beijing claims. I don't know how we compare because we don't know that if we actually trust any of the numbers coming out of China. The National Bureau of Statistics reported that GDP grew 3% last year, but how could it have grown when everything was locked down? So China is back, is how the Financial Times summarized the message. But they're really optimistic, and people that want to believe are very optimistic as well. I don't know. It's kind of like the X-Files. He wants to believe. I want to believe that there's going to be a lot of demand. I'm just not going to believe that it's going to have that big of impact of oil to be able to bring it with the other items in play to bring it over the $100 a barrel. I believe the 80, 90, 100 in that range is going to remain solid for a while. So with that, everybody's getting excited about the China demand. I'm skeptical. So let's come over here for plans for new mid-scale LNG project in Louisiana gaining ground. I'll tell you what, any way we can expand our LNG market, our natural gas, our United States drilling, I'm happy about. Gulfstream LNG development, a recently launched mid-sized greenfield LNG export project, is filed an application to the DOE seeking authorization to export up to 4 million tons per year of LNG to free trade agreements in non-FTA countries. This is huge. It's a 500-acre site, 1.3 kilometers of deep water Mississippi River frontage, is located south of New Orleans. This is really cool. So the article title is Plans for New Mid-Scale LNG. We'll keep you posted on this. This is some really pretty cool news. On the natural gas front, Chesapeake Energy is reducing their drilling amid nat gas price slump. It tells it's a bad thing for the E&P, but it also tells me it's a good thing that management is paying attention. We certainly see that it's prudent to pull back capital, and we think we're going to see others do the same. Chief Executive Nick Dell also said energy firms pulling back in shale in Louisiana and East Texas. We're making money on the capital that we're investing, but the margins are not nearly on a full cycle basis they were historically. So Henry Hub natural gas futures on Wednesday dipped below $2 for just a little bit. Currently, when I'm reading this at 9:55 on Thursday night, nat gas is 2.1. So Chesapeake shares were up 2.3 to 79.77. So really interesting. I applaud Chesapeake for watching their numbers and just taking care of their shareholders. So with that, have an absolutely fantastic weekend. We'll be watching the news and keeping you updated. Well, let's stay tuned to energynewsbeat.com and the Energy News Beat Substack. Thanks. Look forward to speaking to you soon.